What's up, everybody? Anthony Crudele here. Welcome to the Place Your Trades Network. I'm back, everybody. It's been a while since I've been here, and I am super excited to be back on the network. I will be on every other Thursday at 11:30 Eastern, so make sure you're tuned in for that. We are the network that focuses on trading daily options using CME Group's event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, copper, and now Bitcoin futures. That's right, everybody. Bitcoin is now on the event contracts. I'm going to have my boy Trader SZ coming on with me, I think, hopefully in a couple of weeks to talk about that. So make sure you stay tuned for that. And today we have a great show for you. My guest is iMATTHEWRYAN. He's one of the first guys I saw tweeting about GEX Data, and he's just been all over this as an edge in his trading. He's been tweeting about this really for some time. And as we all know, how popular GEX Data has gotten. So today we're going to get into what he's looking at using GEX Data for an edge to day trade futures, options, and of course, event contracts. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading CME Group's event contracts, and they now have it on their regular platform in an options chain, and you could trade it right on the Dome. The Dome is the depth of market, for those of you that don't know what it is, which I will be showcasing in today's show. And I want to hear from all of you throughout the chat today. So please let me know. First thing is I put out there, are you guys using GEX Data? Do you know what it is? I didn't know what it was up until recently. So I'm interested to see what Matt has to say about it. I'm going to add Matt to the screen here. We had a little issue with Matt getting his video on. He's actually in Hawaii. He's one of the few guys that comes in a better location than me. What's up, buddy?
I'm doing great, man. Let me just start by, I want to express my gratitude and appreciation for you, Anthony. Everything that you do, I have the utmost respect for you, and I can't thank you enough for inviting me on your show.
Oh, man, that's awesome. Thank you so much for that. I appreciate it. And look, man, I got to tell you, you got my eyes on this GEX Data early. You, the horse, and a few other people, Leo, and I got to hand it to you, man. I didn't know what it was. And then I started following some of the things that you were doing. I started following you on Twitter, and I give you all the props out there for being ahead of the curve on this. And, you know, it's something that's not new, right? But it's new to so many people. And let's start off with just the basic thing. What is GEX Data?
So let me preface it real quick, though, if you don't mind. There's going to be some people out there, and they're going to listen to this, and some of those people are probably going to be on tilt. They've made some bad trades in a row, and they're frustrated, and trading's not working out for them, and they're looking for that one thing that's going to take their trading to the next level, right? They're looking for that special sauce that's going to make them the trader that they want to become. If you're that person right now, listen to me. This is not it. This is not the secret sauces that's going to make you a seven-figure trader. I think the best way to approach DEX would be to understand market context and not to execute trades. Does that make sense?
Yes.
Okay,
I'm all
great.
about context and nuance, man. All about it.
Here, and a lot of people, when they find me, you know, they're on their last leg and they're frustrated and they're looking for any source just to take their trading to the next level. And they'll hear what I say and they'll have some aha moments, and then they'll go apply it and they'll make a losing trade, and then, you know, they're already on tilt, and then everything that I say is wrong and the market's out to get them. And I just want to make sure that we preface this whole thing by saying this isn't the thing that's going to make you a superior A+ trader.
Yeah, because really nothing does, right? I wish there was something, man. I've been out there looking for it for a long time, but it all comes down to the context of the situation. Look at how different last year was from this year, right? Markets are constantly changing. Some of the tools that I was using last year were just unbelievably accurate. And then this year I use these same tools and they're not working as well just because we're in a different market environment. And if people don't understand that, then they just haven't traded long enough. But this is
I agree.
this is the tool I want to talk about today specifically. I think we're going to jump right into it. And I want to actually share your screen.
Okay.
And just so everybody knows, this is a tool that's offered by TradyTix. We do not work with TradyTix at all. This is just a tool that he's using, and I want him to be able to show us some things. And this is a paid service that he pays for. And there's some free GEX stuff out there as well. And I also should plug that we're going to be having a lot of GEX data coming to PYT soon. But this is from TradyTix, so all credit to them for whatever it is he's showing us. And so let's start off, Matt. Show us some of the things that you're looking at on a regular basis.
Okay, awesome. And yes, TradyTix is my platform of choice, and Hater, he is my guy. I am behind him 100%. The first thing you're looking at right now is called Market Net Flow. And I cannot give you everything that it does because it's proprietary and there is a lot of competition in this business. But basically, there's three types of gamma exposure that you want to know about. Market net flow is going to plot all the options transactions that are being facilitated by the market in real time. Okay, so this is happening as we speak. If you turn on any live flow tool, you'll see those transactions take place. Every single one of those transactions has a delta correlation to it that the market maker must hedge for at all times. We speak in terms of gamma because gamma addresses the magnitude of that hedge. Delta will determine the direction of that hedge, but gamma will determine the magnitude of that hedge. And so you could see that green line, just simply put, those are calls, and the red line are puts. Okay, that makes sense?
Yep. Yes.
So at the beginning of the day, you can see that both of those lines were relatively flat. That means there wasn't much flow participation going on, and dealers did not have much delta to hedge in real time. Does that make sense?
Yes, but I think maybe explain that a little bit more to people. One thing I want to pull back to is when you're
Okay.
looking at this on this specific one, is this something that you're looking at from the actual start of the regular trading hour session, or is this something that you're looking at that is cumulative throughout the whole time? Because zero DTEs are not like an event contract. An event contract actually is a zero DTE because every day it's a new option. Zero DTEs
Sure.
are the weekly options that are expiring on this specific day. So when you're coming into today's, I'm just curious, this is something that you're looking at cumulative to this point, or this is what it is actually just for right now?
Great. That's a great question. This is start of market open. So
Okay.
at the beginning, this is where whenever you want to place an option transaction, this is what it's calculating from the moment you can do that. And unfortunately for us option traders, we can't do that until 9:30 a.m. Eastern Standard Time. I know you can trade your event contracts anytime, right?
Yes.
Yeah, you're not bound by time like we are bound by time. So at 9:30 when the market opens, this begins to plot all of the option transactions that are taking place in real time under certain thresholds and filters that this specific model provides. Does that make sense?
Yes.
Okay, so just simple, the green line will represent all the calls that are being bought or sold on the market, and the red line will represent all the puts that are being bought or sold on the market. Pretty simple.
So let me ask you this, looking at this, it looks like there was a lot of calls being sold then in the middle of the day
Correct.
before it was down,
Yes,
right?
sir.
And so
Yes, sir.
the puts stay almost relative to where we started the day. And
Yes,
then
sir.
talk about the market net flow when I look at that white line going up. So what does that tell you?
We will take that all that flow and we will plot it against the SPY. So that white line is your price of SPY.
And what does
The,
it indicate when it gets above that red or green?
nothing,
Anything?
zero correlation between the two lines. What we're doing is watching how flow participants are positioning themselves in relation to SPY. And this is important because we can deduce, let me rephrase that. Price becomes more predictable when we understand what flow participants are doing.
Why?
Perfect. Because we know that if you smack the market maker with a certain amount of delta, they are required to hedge for that delta. So if the flow participants are selling calls right there where you identified, we know that the reaction from the market maker, they are sellers of the underlying. Does that make sense?
Of course. Yes.
Okay. And so if they're buying calls at that same spot, at the same point, they're buyers of the underlying. And so there's this reflexive loop of the market that we understand that dealers have to hedge a certain way depending on the flow that comes in. Now, the edge that we find is when that flow diverges, when calls are being bought and puts are being sold at the same time, or puts are being bought and calls are being sold, the dealer must hedge in the same direction for that divergence. as you can see at the beginning where the lines are flat and they're crossing over and there's no real magnitude of divergence there, there is no required hedging. And the reaction in the market will be more from the common stock side, the equity side, and not the flow participant side. Does that make sense?
Yes, I understand that. And I'm curious if you guys are out there listening to this, please put your questions in the chat because this is a very interesting topic. I think a lot of people are looking at GEX data and did not know probably most of what he just talked about.
Right.
And
Look, I'm sorry to cut you off. Go ahead.
no, you go ahead.
It's counterintuitive when you see it and you try to read about it. But if you can understand these concepts, it's not counterintuitive at all. You just need to get on the side of dealer hedging. And this tool shows you how dealers are hedging. Okay. So at the beginning of the market, when it's relatively flat and no hedging is taking place, I don't have any edge there because I know that dealers are, one, barely hedging, and two, they're hedging in opposite directions. My edge comes from when I find that they're hedging in the same direction, and that is when flow diverges.
So let's give an example of that. So talk about something that you would look for here. So you would look for, it would be same direction, would be buying calls, selling puts, because that means that they're all looking long.
Yep.
If you see that,
if option participants are in agreement and they're buying calls, and at the same time they're buying calls because they want to go long, they're also selling puts, which is a sign to go long, right?
yes.
Selling a put, you think the market's going to go up, then we know that based on that reaction, dealers are forced to also be buyers of the underlying. And now we have dealers on our side as we're taking our trades. So we're using dealer hedging as confluence to read market context and to initiate trades. Does that make sense?
So does that mean that you're stepping in and you're getting long, you are bullish?
In that scenario, when calls are being bought and puts are being sold, yes, I will have a bullish bias.
Yeah, because that just makes sense, because what you're saying is you're getting confirmation from both sides, and then you step in and you buy the underlying, because if both sides of the options are pointing in the same direction, that's pretty clear path that most likely that's going to turn into that directional move in the underlying.
Hey, baby, that's edge, right? That's what everybody's looking for.
And so, talk about a situation to where you see the opposite.
Okay, so when flow participants aren't in agreement and flow is not diverging, kind of like at the beginning of the day for a perfect example, there's no edge there for me because market makers aren't, one, required to do much due to magnitude of gamma, but also because it's not diverging. So it's a great time just to remain patient and wait for edge to play out in the market, to hunt for a setup instead of just throwing a bid out there and being hunted in the market. Does that make sense?
Yeah, of course. So basically it comes down to, when you're looking at this, the ultimate edge where you see the clearest path to a trade is when you see the calls and the puts giving you the same indication. So whether they're buying calls, selling puts, or they're buying puts, selling calls, when you see that, that is when you step in and you see the cleanest edge.
Yes, price becomes super predictable when flow diverges, right? And so as those two lines, that red and the blue line, start to diverge from each other, the tips are increasing in distance from each other, and more money is being spent. So the magnitude of the premium is really smacking that market maker. We can predict price much easier.
Yeah. So what he's saying, everybody, and I mean, it's visually, you want to see those lines pointing outward. And when you do, that is telling you the clear direction of the market. And
right, if you look onto the right side of that graph where it says cumulative net premium, right now you can see that they're both under our zero line, which now they're in the negative million. So the puts are hovering around negative 1.5 million spent. So they're selling puts there. And the calls have kind of flattened, but they had pushed down to negative 6 million. So they're selling calls there as well. Do you see that?
Yes.
Right. And so both participants, calls and put, they're not in agreement. Flow is not diverging. So there's no real edge here. And the market is being more controlled by common stock participants than flow participants right now.
That's an important point because
This is very important.
yeah, because what that is indicating is that there are times where the options are, although what some may say on Twitter is that the options necessarily aren't in control of the current price action, like as you see today. And so what you're saying is that this is when the actual activity coming through the underlying directly is going to have more of an impact on price.
Correct. That is correct. But we're also coming into a big options expiration today. And so dealers are de-hedging. They're doing a bunch of stuff. You can see flow participants are on the sidelines right now. They're simply not spending money on options contracts, right?
Which is interesting going into a day where we have tomorrow. Well, but actually, so I should clarify this. This is just for today's options.
Yes, sir. You're
So
watching it
because the
in
one
real
thing
time.
is, yeah, I'm thinking in the back of my mind because tomorrow's unemployment. Why wouldn't options activity be
I
maybe?
believe the market's closed tomorrow for Good Friday, right?
Yeah, it's closed, but going into the weekend because tomorrow's unemployment, the only thing open is futures. So I was curious, almost what that would look like, almost on Monday, in a sense, what those options would look like, because there's obviously got to be some people doing some hedging or something going on going into the weekend. I know if I was long a bunch of outrights, which I won't be in unemployment, if I was long SPY, I would probably be doing something in the options to offset some of that, just in case tomorrow is who knows what tomorrow could be with unemployment.
It's got to be tough though, because they're going to pay some hefty fees for holding those contracts over the weekend, right?
Yeah.
So I don't know. Like you were talking about how markets are evolving every day. There's more option participants in the market now than more than ever.
Yeah.
People are zeroing in on zero dates to try to spend less premium and leverage a bigger reward. It's just always evolving. And so look at this market net flow tool from a intraday perspective. I would not take any of this data and swing it to my next day, but we do have some information that we could talk about that after we talk about this.
Yeah, no, I think this is pretty self-explanatory. I think everybody out there, if you guys have any questions on this, I'd love to hear from you guys in chat. And Shy Girl saying this might be helpful if you're not used to the Greeks. I'm not used to the Greeks. The only thing I know about the Greeks is I play cards with a lot of the Greeks, and that's just maybe my little joke. But I think
the Greeks.
What's that?
I think the Greeks are important to understand, but if you are sitting on the sidelines afraid to jump into options because of the secondary Greeks, it's not a valid concern. You don't need to master them to be able to understand this. Does that make sense?
Yeah, absolutely not. I mean, this
Yeah.
is as long as you understand what a call and a put is.
I mean, look at the screen right now. Look at the calls rising from the bottom, and look at this price of SPY rising. If I just take off our put data because it's staying relatively flat, so let's just remove that real quick.
Yeah.
You can now see that the price of SPY is rising and calls are rising. And what is happening as more calls are being facilitated by the market, dealers are hedging in real time by being buyers of the underlying and thus also propping up the price of SPY. Do you see that?
Yeah, absolutely. Man,
Super simple.
Yeah, super
We
simple.
we don't need to know anything about the secondary Greeks. We can just see this plotted out in real time and start to form our market context of what is happening.
A question about this is how often do you see a scenario where you would see the calls starting to push up and then potentially price starting to come down? How often do you see it not work?
So that is going to be dependent on a few things. The further out of the money that calls are being bought and the longer dated those calls are, will have less of an immediate impact on dealers.
So how do you narrow that in on that number? Because that number of calls that's being bought, what is the range of those calls that's being bought? Like how is it every call that's on the book?
It is not every call. This is specific filtered data that I can't tell you what it is because it's proprietary. And like I said, there is a ton of competition in this market, and platforms are stealing tools all the time. I know that. It's very competitive.
Yeah, I get it. But overall, what you're saying is, so this is a filter of calls, basically, whatever, doesn't necessarily matter what it is, right? But at the point of it is that it's not all of the calls. It's what they believe is the most relevant to the situation.
It is all the calls and puts that are bought under a certain parameter that we
Yeah,
know have a direct correlation that moves the SPY,
got it.
right? So we've taken out some very important things that have no correlation to the SPY.
Interesting. What else on here do you want to show? Because I know we've only got a little bit of time left, and I actually want to pull up some things on my end as well.
Yeah,
What
sorry, I could.
other clear tools? Because I mean, I think that I'd love to have you back again and talk to us about these conversations. And I don't want to get too in depth today, but I think that in its own right, just that money market net flow and that calls and puts is super simple. That I think anybody who's trading this stuff, trading the equities, can understand. Is there anything else that maybe falls in the same category of simplicity as this?
Absolutely. And this is just, again, this is gamma that is being transacted in real time. There is gamma that is sitting on the order book that has taken place in the past that hasn't expired yet. And that is a lot of what you're talking about with gamma exposure. So just for clarification, this is happening in real time, and that isn't gamma that is sitting on the implied order book.
Got it.
Okay. And so if we want to see that, we have a few ways. We can come down here to our options tab under our ticker dashboard. And I hope Trade Tick cuts me a check for all this free promo I'm doing for him. All right, sorry. And this will load up. And as we scroll down here to see all these beautiful models that Hader has built.
Part of my issue as you're scrolling through it, all this is like, I've gone into Unusual Whales. I've gone into these other ones. I haven't checked Trading Ticks out. Now after you seeing it, maybe I check them out too. I feel like in some ways I'm overwhelmed. Not in some ways, I
Yeah.
am overwhelmed by the amount of tools. And I feel like, just knowing the simple ones is all we need. I mean, as traders, and we're going to get to how I feel like this is a great play for event contracts and futures traders in general. I just want to know direction. I mean, and I think that, a lot of these tools, and I'm curious from your perspective, I mean, how much of all of these tools out there that are being produced, and I'm not talking about Trading Ticks specifically, but just in general, are just things that are just almost redundant.
It's subjective to the user and how the participant sees the market. I can't
Yeah,
really talk to. I'm not a quant that works for Goldman Sachs, so I'm sure some of this data in here they understand that goes over my head, right?
sure.
But as a retail trader, I have not found a better platform where the brand, where the owner, where everything is just for the retail trader, trying to get you the information that you need and eliminate the noise.
Got it.
But it's hard, there's all this data is important. It depends on how you trade.
Oh, no, absolutely. And I preach that more than anybody. So what are we looking at here before we get to what I want to share on my screen?
Okay, so
It'd be interesting.
the second thing we need to know is the implied order book, and that is all the gamma that is sitting on the dealer's book that needs to be re-hedged as price comes back to those levels. Does that make sense?
Explain it.
Okay, so let's say that some really big whale buys 5 million, 10 million, $20 million worth of calls at 412, SPY 412. Right, that bar right there is showing all the gamma that is sitting on the strike at that strike on that dealer's book. Okay, and as price comes back to these levels, as spot moves back to strike, dealers are required to re-hedge for that gamma that they already have on their books because it has not expired yet. Does that make sense?
That I understand. Yes.
Okay, great. So what I do is we can see here each expiration, which has the most gamma sitting on those OPEX. As you can see, 4/6, which is today, 41.8% of all SPY gamma is sitting ready to be expired, ready to expire. Pretty clear, right?
Yes.
So we can just come here and I can simply sort by filter, and I can come to the 4/6 OPEX. I can pull up that data, and you can see that the 412 has a large aggregation of gamma sitting there. And we can see the second one is the 407. If you want to pull up your charts from Monday, and you can see how prices bounce between 412 and 407. I don't think we hit 412 tops. I think it was like 411.90 something, but you can see price bouncing between these strikes. That is because dealers are forced to hedge when price comes to these strikes. Does that make sense?
Yeah, exactly. So what, real quick, before I go to my chart, just to show that and to go over a couple of other things, what does that indicate to you on a day like today?
That's a great question. A day like today is going to have a little bit of different caveat because all of this gamma needs to get de-hedged by the dealer. And we would need more time to talk about de-hedging. And so if it wasn't OPEX right now, I would be looking at these major strikes to act as either magnets to be priced to be pulled toward them or to act as support and resistance based on what type of gamma they are.
Got it. And what's interesting is that we've recovered the 407 right now in SPY.
Yep.
Look at that. So I'm going to pop over to my screen. I want to talk about a couple other things, I think, to help people and maybe put these things into play, talk about some positions I have on right now as well. So we move into here. First off, we pull up the SPY. He talked about the 407 and the 412s. Look how interesting that is. It's like you said, it's pretty much the high right there. And then today, tried to stay below it, gets above it, and now you're seeing actually the rally surge a little bit here, which is interesting, and then obviously you could take this into play and use this for the E-mini S&P, which is futures was what we do. So knowing these things on the SPY really does spill over to the S&P. And so when we look at event contracts, a couple things. I'm actually going to pull up Trade-Evate now on here. And actually, I have a position on. I'm actually long 50 of the event contracts right now.
Let's go.
Yeah, let's go, baby. And it's the only position I have on right now. And I want to kind of go over why I took that trade today before I get to the S&P. And I want to show people how this now on Trade-Evate has now been able to trade these right here in the dome, which I really like. And like I said, I've been snapping them around quite a bit lately. So here we are. Here's you and I. You got to click live to watch it. But this morning, we talk about this a lot, these quant stats, and look at HG. Copper right now is a hot market. It's not a market that I trade very actively at all. How about I don't trade it? I got enough going on in my life, man. I can't be stepping into copper. To me, it's a new market to me. But when I looked this morning at a 1.7 profit factor and a 56.6 probability of closing above the open today, and so I want to show everybody something that you could use the event contracts for. So you go to the chart today, and this is the one thing I think that people, this is why I've actually been trading several 0 DTEs as well in the micros and on the SPY and event contracts, the gamma data and some of these quant stats. When I looked this morning, I saw that copper broke and I saw that we had basically some support started to hold up in this area. I stepped in and bought event contracts versus stepping in and buying futures. And that position cost me $450. I'm long from 875 because I bought 50 of them. And versus, and I could show you how you trade it right here on the dome now versus before we were talking only on the app. So for day traders, actually, I'll probably snap a couple off here just to show you. So I sold 15 there and you could do it right there into the dome. I still got 35 left, which I'm going to take into the close now because the quant stats support it. So I wanted to show that you can trade event contracts using them just like support and resistance, but it's fixed risk. It's also fixed reward, but I like the fixed risk a lot because here I doubled my money basically on that position. I'm showing it to you as it's happening. And it's like for me stepping into copper futures, for sure, I would have butchered that trade. And you could buy as many as you want. And you could trade them right here in the dome. One thing that we're going to go to now is I want to show the event contracts for today. You could see all the strike prices. And so basically, so now I can't see where, let's see what it was. So while we have actually a decent rally, 25.5 right now, since you and I have been on, Matt, they've been going. And so what you could do is if you pull up the Trade-Evate app, you could right click on it, click dome, drag over to here, you could pull in. And you could see basically this is the 4120 strike. And then now you can trade these everybody like they're right here in the dome. And you could trade them like you're trading futures. It's canceled because you can't short them yet, but being able to short them is coming soon. So you can see you can step in and do that right there. So I think that's pretty cool. And what's interesting is you take what a guy like what Matt was showing us today. And I think that 0 DTEs, Matt, you've been trading obviously for a while. And the one thing that I would say is that if you don't have that edge where you have that look, and I have stepped in and traded a lot of these 0 DTEs, those things evaporate so quickly when you're wrong. It is like, it is unbelievable. And so I feel that unless you have like that gamma edge almost in it where you really see it and like it, do you feel that there's almost, I mean, you could say this about any strategy, but there's a very difficult way to pull money out of the market when you have these zero DTEs that really expiring that day. They go against you so fast if you're wrong, if you don't really have that edge. And that's why I think these gamma tools are so popular, because it really does hone in, and really what they're trading like futures, basically, these zero TTs. I'm just curious what your thoughts are on them in general.
I think that zero DTEs are probably the worst trade that new traders can make. They're enticed by the price of those contracts, and they think that they can buy more because they're cheaper, and if they're right, they're going to get a bigger reward. But those contracts are the closest to expiration that you'll ever find, which means that the market maker is sucking the premium out of them every tick you get closer to close. If you don't have a trading strategy yet that you can return, I don't know, 75% of your entries into profit, I would caution staying away from zero DTs and pushing out expiration. It'll give you a lot more safety if price, if it dips and you got a hard stop on your bracket with that much theta that close to expiration, those swing dips are going to trigger your stops 100%. And you're going to be sitting there frustrated as price moves in your direction without you. It's just not worth it.
Yeah, I mean, I can't even tell you some of the things I've done in zero DT. It's embarrassing. But I will tell you this. This is why I think, obviously at Place Your Trades, we focus on futures. We talk about micro futures. We talk about event contracts. I think for a lot of the zero DTE traders out there, you can come out there and do this, and it's fixed. It caps at 20. Okay, it might show higher on here, and it caps at 0. And you don't have that decay intraday like you do, because this is all based upon the close. If we're going to close above or below a price, that's what each one of these strikes represents. On the left-hand side's the calls, on the right-hand side's the puts. And I think for certain instances, especially with these gamma indicators, which we're going to be providing more at Place Your Trades, this is a great way to step in and do it. And as you can see, I showed you guys today what I was doing, with copper, and you could trade it, and you see copper's running up here a little bit more now. And they all close at $20. And so you could trade them just like you're trading support and resistance, and step in and do it. And I think for the S&P, using those gamma indicators can be really interesting. I could tell you I've had some decent success with them, just trading these event contracts. And so just wanted to showcase that as well. Matt, all I could say, buddy, is thank you so much, dude. I'm going to tell you, man, it was a pleasure to meet you. You explain things, I think, in such a good, clean way that I think a lot of people can take a lot from this. And like you said, trading ticks better, the check better be in the mail, because everyone's probably taking a look at their tools that tuned in today. But you explained it so clearly, man. And I appreciate you getting out there early, showing traders this stuff. And you're just a good guy, man. So I appreciate your time today.
Thanks for the kind words, man. I can talk about this till the cows come home. I'm obsessed with it. I spend all my time on it. People have to tell me to shut up because I'm just talking about it way too much. So yeah. I appreciate you, Anthony. I respect you, like I said at the top, and just for you to invite me on here, I'll be honest, man, it made my year. It's the highlight of my 2023 so far.
That's awesome, my brother. Well, it was great to meet you, and I definitely learned something from you, and I appreciate your time. Everybody that tuned in today, please reshare this later. We got the tweet out there. Let people could watch this. It'll also be available on our YouTube channel later. Give Matt a follow on Twitter. He's massively underfollowed on there. Dude should have a lot more followers. He's the real deal. He's out there and he's helping traders. He's not out there just pitching junk. He's a really good dude, as you could tell from today. And remember, everybody, this is sponsored by Tradevate. Check out not only the app. We didn't show the app today, but I showed you that it's available here on the Tradevate platform, which is really cool. I think it's a great gateway entry to options. And even for advanced traders, it's a great way to step in. And make sure you follow us on Twitter at Place Your Trades, and stay tuned, as we're going to have a lot more stuff coming on this on-air page. So we appreciate you guys for tuning in today. Matt, we're going to have you back on again soon. And I think I got to have you on Futures Radio soon as well, my friend.
Hey, if you put me on Futures Radio, I'll retire happy, man. I listen to every one of your podcasts, sir.
It's going to happen, man. So get ready. We got to make sure that camera's working, though.
For sure.
All right, everybody. Peace.